Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. The Nifty and the Sensex surge almost 1% each. Reliance Industries, ICICI Bank and Titan hit record highs.
Strong foreign flows help the rupee turn positive on a year-to-date basis.
The RBI argues that yielding to Kotak Mahindra Bank's pleas in the Bombay High Court will undermine its authority.
Dr. Reddy's lab seeks over $70 million in compensation from Indivior for the delay caused in its Suboxone launch.
Let's first take a look at how markets are faring. 1% higher on the benchmark indices. Yatin is here with us. Afternoon, Yatin.
Afternoon, Iran. Something like yesterday's move, 100+ points gain on the Nifty coming in at this point in time. We are trading, around that 11,300 mark on the Nifty, with advance decline ratio also on the Nifty remaining healthy. 4 advances for one, stock declining. What's gaining in trade is Bharti Airtel. That stock is clearly, doing quite well. Probably, a 15% move has come in for the last 5 trading sessions. So 350 rupees and plus looking higher for Bharti Airtel. L&T, ICICI Bank and Adani Ports, these are also a few stocks which are on the positive side. What losing in trade is again the IT pack. Like yesterday, today also we are looking at some selling which is happening for the IT pack. So we have the likes of Kotak Mahindra, Infosys, TCS, all of these stocks slightly under pressure, almost 0.4% down for all of these stocks. So also losing on the Nifty is Infratel as well as Bajaj Finance. Both of these stocks down anywhere between 0.6% to 0.5%. And finally, in the mid-cap space, we have a couple of stocks which are quite active. So we have the likes of Reliance Communications, Ashok Leyland, all of these stocks active in the future and option segment, wherein we are looking at some long unwinding which is happening in all of these stocks.
Yatin, thank you for that. But let's talk about the banking index. A lopsided banking index makes it possible for some traders to manage the Nifty Bank, that's the weekly options for quick returns. And all the action is happening in the last 90 minutes of trade on the day of expiry. Devina is here to tell us just how it's done. Devina.
Well, so this is with regards to the weekly expiry that happens with the Bank Nifty options. And because the Bank Nifty is lopsided, the majority of the weightage that is being held by HDFC Bank, which is one single stock. The others, like Kotak Mahindra Bank, hold another 13%. So put together, they're about 50-odd%. But just the fact that traders are using HDFC Bank to play up volatility and bring about a change in option premium in the last 90 minutes of trade is something that's being observed very closely over the last 1 year in terms of the weekly options expiry. So starting off with the number of volatile days that we've been seeing since the start of the options expiry in mid-2016. So the number of days where the Bank Nifty actually swung 200 points in the last 90 minutes of trade, from 9 days in 2017 shot up to 21 days in 2018. That's almost double in terms of the volatile days. If you take a look at HDFC Bank, which is holding 35% on the Bank Nifty, the 1% swing there on HDFC Bank was for 33 of the days in 2018, and you map it onto what Bank Nifty did, and it overlapped on all of those days. Now, if a 1% move on HDFC Bank swings the Bank Nifty by 100 points at the current market price, so you can imagine the kind of move that happens. Now, what happens is option traders buy options, out of the money options, 1 day prior, and then in the last 1 hour of trade, they use HDFC Bank to drive up the Bank Nifty prices. Now, since during expiry, the only thing that's remaining in the option price is the delta, or the rate at which the underlying moves. This is what they do to make sure that the premiums spurt manifold. So from 9 rupees, out of the money option can even surge to about 100 and 150 odd rupees, and that's how they land up making money, because the time value till options has already been eroded, and the only thing that affects the price then is the underlying price which they use to manipulate.
Navina, thanks so much for that. You can read more about that on BloombergQuint.com as well. The Bombay High Court will hear the Kotak Mahindra RBI case today. The regulator, which has filed its response, has argued that its authority would be undermined if Uday Kotak is given an extension based on the arguments it has made, or if it's allowed to use the route that it had chosen. Saloni Shukla of Bloomberg News, who's seen RBI's response, joins us on the phone line. Saloni, what is their argument?
Ira, so clearly, as you articulated, just now, they have made 2-3 crisp arguments, in the response which they have made to Kotak Mahindra Bank's petition. The first thing that they have said is if the Bombay High Court goes and allows Kotak's request, then it would undermine RBI's autonomy and independence. The second most important thing which they have said is that they have alleged that there is some motive, some hidden motive behind Kotak Mahindra Bank going and approaching the court and undermining, the RBI's diktat, because time and again over the years, when even the license was given to Kotak Mahindra Bank, for so long they have kept asking, for extension of the deadline. So the RBI says that, first they said that there was global slowdown, then there was volatility, and now they are saying that there is market capitalization of the bank has become so big that they cannot go and reduce, this holding at one go. So the RBI is saying that it is the bank's fault and not the RBI's fault for increase in market capitalization, and the bank should go ahead and reduce its promoter holding. Also, one more important thing which Kotak had said, that, if it is forced to reduce its holding, that the bank would become foreign held. So RBI has said that the bank wants promoter holding to continue and not foreign ownership. So it's a very interesting response which the RBI has made, and clearly not backing down.
We seem to have lost Saloni, but that's the crux of the story that's going on with Kotak today. Meanwhile, shares of Lakshmi Vilas Bank spread spiked unusually in the last few sessions, even as the private lender grapples with bad loans and a capital crunch as well. Strangely, this surge came right after ratings downgrade. Sajid is here and he's taken a closer look at the stock movement to find out why it's actually going against the news flow. Sajid.
That's right. If you look at Lakshmi Vilas Bank, the bank has been in need of capital, and the capital adequacy ratio of the bank is poised in such a way that if it doesn't bring in equity capital by the end of the month, it may end up in the PCA framework. And that's one of the reasons why the bank has already taken approval from the shareholders for a QIP. What has happened is that on February 25th, Brickworks Ratings, one of the rating agencies rating the bank, downgraded the stock from BBB plus to BBB minus for an unsecured NCD of 50 odd crores. Post that, what we saw is that the stock started running up in the market, and it ran up by nearly 45% in 6 days. In the entire duration of that, there has been no information with respect to why the stock was running up, but it was a speculative run-up which was there. And suddenly on March 5th is when the bank came out with an announcement that its board is going to meet on March 7th to mull a preferential issue or a tier 1 bond to raise capital for the bank. As soon as that announcement was made, March 6 was the highest that the stock hit of 80 odd rupees, and on the day of the board meeting, we saw that the stock started falling, and the stock has fallen by nearly 10% from the day from the high that it touched. What is very intriguing is the kind of volumes which have gone up in that period. From Feb 1st to Feb 25th, we have seen the volumes rising, average volume of nearly 1 million shares on the NSE. And from Feb 26th to March 6th, which is a day on which the stock hit a high, we saw volumes of 5 million. That's nearly 5-fold jump in volumes happening on the stock. And this is very intriguing because the stock, which was under pressure because of a rating downgrade, had shown unusual price rise and unusual volume rise in that period. And our queries to the bank management asking who were aware of the board meeting and the agenda of the board meeting has remained unanswered.
Sajid, thanks so much for that. Indian equities are finding favor with foreign investors of late, and a large chunk of this is coming into bank stocks. Data released by the NSDL shows that banking stocks saw a net inflow of $761 million in the last 2 weeks of February. Samit Sarkar is here with the details. Samit.
Well, if you see, the banking sector has seen some favor among foreign investors in the last month. Now, according to the data put out by the market regulator, that is SEBI, foreign investors have turned net buyers of banking stocks for the first time in the last 8 months. Now, deploying nearly 60% of the total funds, that is nearly $1.3 billion US in the month in the banking sector in the month of February. Now, if you see, the amount received by this sector was also the highest from foreign investors in the last 2 years. Now, this inflow was despite the sector's underperformance seen in the last month. Now, if you see in the last month, the PSU Bank Index and the Private Bank Index, now they fell nearly 8.8% and 1.3% as compared to a decline of only 0.4% by the Indian benchmark, that is the Nifty 50 index. Now, along with banking sector, the other sectors that had seen some favor coming in from the foreign investors include the likes of non-banking financial companies, IT, media, chemical, pharma, insurance and telecom. While on the flip side, if you see sectors like FMCG, capital goods, metal, aviation, retail and logistics had seen some outflows from foreign investors. Lastly, on an overall basis, if you see in the last month, foreign investors pumped in nearly $2.4 billion US in the Indian markets, which was at a 15-month high in the month of February 2019.
So, thank you for that. As engineering, construction and infrastructure companies struggle to recover thousands of crores stuck in arbitration claims, often against the government, litigation finance is fast becoming a viable route for raising funds. This is the latest to choose this option is HCC. Vishwanath Nair is here to tell us if this is indeed a trend.
Right, Harsha. So what we understand from our sources is that lenders to Hindustan Construction Company last week, they approved a resolution plan. As part of the plan, there is a portion of the debt, 4,000 crore debt, which is getting converted into long-term equity-like instruments, and the rest of the debt is going to be serviced. But more interesting part of this resolution plan is that there's going to be a sort of securitization of their claims against the government. HCC currently has nearly about 10,000 odd crore worth of claims. Nearly 4,800 crore have already been awarded by the arbitration tribunals, while about 4,900 crore is still in the process of arbitration. Now, what we understand is that investors will come in and either buy the entire pool of these claims, or they will purchase a small portion of it. How this works is they will buy these claims, they will continue, the investor will continue with the legal procedure of recovering these claims, while the company gets paid out, and any loans that have been taken against these receivables will get extinguished accordingly. How litigation financing is important is because EPC companies have largely struggled in India to find an apt resolution plan which could address a lot of their structural issues. Primarily being EPC companies don't have assets of their own. They are essentially building assets for somebody else. So to avoid that situation, this litigation financing will take off the legal struggles that the company are facing off their plate and let them focus on their core business of construction. Now, HCC is not the first one to do it. It's only the latest. In 2017, we saw Patel Engineering, and another construction company, which actually did a similar structure. At that point in time, 8 Capital, which is a distressed asset investor and a private equity firm, they had bought some of the claims that Patel Engineering was controlling, and they had paid bankers in the form of debentures with a 6-year repayment period. So essentially, as and when these get paid out, these claims get paid out, the bankers will also get paid out on the other end. We've also seen companies like EIX Infra, which is one of the 12 large companies under the Insolvency and Bankruptcy Code, where the resolution professional is suggesting this to the lenders, and the lenders are currently assessing plans and looking at where they can make such deals with interested investors. Deals are difficult to come by because, essentially these need to be litigation claims which are against the government, where there is a high probability of getting paid out at the end of the legal procedure. If there are related parties, then obviously that becomes a problem. So yes, deals are difficult, but of course this is becoming a more preferred route for a lot of construction companies to resolve some of their more structural stress.
All right, Krishna, thanks so much for that. Let's move on. Dr. Reddy's Laboratories has sued Indivior for more than $70 million to compensate for the delay caused in the Suboxone launch. Remember, the Suboxone patent lawsuit filed by Indivior had forced DRL to delay the launch of the generic version of the drug. Bhuma Srivastav, Bloomberg News, joins us with the details. Bhuma.
So what we know is that Dr. Reddy's is seeking to claim more than $70 million from the patent holder, which is Indivior, for the lost sales. So in July last year, they managed to block the generic version coming from Dr. Reddy's, which the company claims caused them lost sales, and they're now seeking to recover that. So in some way, it is like clawing back the losses that they've incurred as a result of this injunction.
Interesting that. Bhuma, thank you so much indeed for joining us. That's the story for what Dr. Reddy's is doing.
All right. Let's move on. We will move on to news coming in from the travel space. EIX is looking to acquire Yatra online, the parent entity of travel portal Yatra.com, for about $336 million. This is as EIX is looking to boost its travel business in India. Nishant Sharma reports.
Software firm EIX has offered to acquire India's online travel platform Yatra.com for about $336 million, either in cash, stock, or in a mix of cash and stock deal, as per the Yatra.com's board, as EIX looks to boost its travel business. Now, the US headquarter firm EIX said that it wants to merge its EIX Cash, the remittance business, with online portal Yatra.com on Monday. The Atlanta-based companies, which provide softwares and other e-commerce services for insurance, financials and other sectors, said that it is providing a share price of about $7 per share, which is approximately a premium of about 75% as per Yatra's last share price as of Friday. Now, Yatra in a statement earlier today said that it has received the offer and is currently reviewing it.
Nishant reporting there. Let's move on. The Balakot airstrike has boosted the government's approval rating, according to a survey conducted by C-Voter. Tamanna spoke to Yashwant Deshmukh of C-Voter to find out if the sudden spike could help the Modi government win a second term.
In our tracker, which we have been showing on a routine basis on all the national networks, January numbers were the lowest in the last 5 years that this government and Prime Minister could have said. And for the last 4.5 years, we have been reporting that the approval ratings of the Prime Minister and this government have been going down on a secular basis. And they have, been at the rock bottom level as per their own standards in January, when PM's approval rating for the first time in 5 years went below 50 point mark. So it was the alarming sign as far as the government and Prime Minister is concerned. But after the budget, I think that is where precisely the things started to change. The 10% scheme for the upper caste, which happens to be the core voter of the BJP, also the personal taxation things that were taken up in the union budget, they all started to actually making the downward trend, stopping the leakage, as I would say. And then all of a sudden, after the Pulwama, we see a sudden spike in the jump for the popularity of the Prime Minister as well as the approval rating. Now, some people might say that, how can a terror attack actually, because it is before the surgical strike, how can it be seen as a positive thing to happen for such ratings? What happens is that after such a terror attack, when the country is kind of in an emotional trauma, people at large, the public psychology goes like that. They stick to some strong leadership. They stick to a leadership which they feel is going to deliver a counter attack, or as they say, कि नहीं कुछ ना कुछ तो बदला लेना ज़रूरी है.
But in fact, time and again, the incumbent gains trust in times like this, because your bread and butter issues like lack of jobs, or how business is going, or inflation, or any other such issues sort of get overshadowed by a larger sense of threat. And you look towards your government, and then you don't really look at which party is there at the helm. And I mean, that's historically we've seen it happening again and again.
That's it. And that is where probably the opposition has to be blamed. In our tracker, way back in January 2015, the top of the mind recall problem in this country became unemployment. January 2015. And we have been pulling out this data and doling out this data on week after week after week. Can you imagine? Did you hear or did you notice even for one single time in the last 4 years that opposition actually put it up as an issue? Did the media care that this is the time that we should say that after a long time unemployment has become a critical issue as far as the public of this country is concerned?
To be fair, Yashwant, it's no secret that unemployment is a huge issue. In fact, which is why this whole back and forth with the government claiming that the unemployment is not a big issue, and numbers and data thrown back and forth. The opposition has also taken up unemployment, but you have a fair point, not with the ferocity and focus that they could have.
My point is, opposition was too late in picking up those issues. Number one, they started to pick up the issues only when we were nearing the elections. Number two, number three, the blunder was they should have stuck to those issues. Every time there was an issue, then they were trying to make an issue out of it. Somewhere out from the blue, Mr. Rahul Gandhi came up and started picking up on Rafale as an issue. Now, We have done tracker on Rafale. We have done, a complete thorough study on the public sentiment on Rafale. The allegations are not sticking to the image of Prime Minister Modi.
A multitude of litigations have tested the 180-day timeline mandated under the Insolvency and Bankruptcy Code. A research conducted by researchers at the Indira Gandhi Institute of Development Research indicates that the probability of an insolvency case being resolved within the 180-day timeline is just about 5%. The probability, though, rises quite sharply in the 180-day to 270-day period. Joining us to talk about that research is one of the co-authors of the report, Bhargavi Zaveri. Bhargavi, thanks so much for joining us here on Bloomberg Quint. First, just a request to detail some of the key takeaways. The 5% probability of a 180-day resolution does seem a little bit low, although taking cognizance of the fact that this is still a relatively new piece of legislation.
Sure. So I have with me my team as well, and we've authored this together. So yes, 5% in the first 180 days does seem low. I think I'm not sure if that shocks anybody, actually, the finding, but it's just a more rigorous way, a statistically rigorous way of arriving at this probability. One disclaimer that I want to make is that this is on the basis of cases which were admitted from December 2016 to June 2018. And this should not necessarily be attributed to the tribunal capacity as well. As we all know that the creditors committee process is actually driven by the creditors, and there are very few touch points with the judiciary. So this is just generally how much a resolution process takes, and it's not necessarily due to tribunal capacity issues.
Sure, Bhargavi, a slightly bigger question. So what is the inference that you draw from this finding of yours?
Guys want a picture? So the inference is as follows, that with enough data, we are able to estimate the probability of case closure within the 180-day timeline, 270-day timeline. Now, there are three immediate benefits of this. If we are able to do this on an ongoing basis, it will tell us how the bankruptcy ecosystem is evolving. So, for example, we will be able to understand if creditors committees are getting speedier and more efficient in making decisions. We will be able to understand if tribunals are getting better and if resolution professionals are getting better, if the probability of case closure within the shorter timelines increases over time. Secondly, the moment you have this probability estimate, it immediately allows stakeholders to plan their affairs better. So, for example, if you tell me that the probability of case closure within 180 days is 5%, I as a creditor I'm better placed to make a decision whether I should choose to settle, or should I choose to pursue litigation, or should I choose to pursue the bankruptcy proceeding at all? And on an ongoing basis, I guess it tells us about the evolution of the bankruptcy ecosystem.
Bhargavi, a couple of specific questions. So one, if you were to strip out the top 12, the large 12 accounts which were first referred to insolvency by the RBI, if you strip those out, would the findings be any different? I ask because, those were large, complex cases which had been, gone through various structures of resolution over the years. So perhaps resolving them would have, taken a certain amount of time which would not fit into the timelines under the IBC.
Yes. So, if you see, there's research to show that most of these 12 cases have been in resolution for more than 500 days. If we strip them off from our findings, will it make a difference to our findings? I'm not very sure. This is a case study of 761 cases, so I don't know how much 12 cases will make a difference to the overall findings.
Okay. Bhargavi, also you have some analysis based on, whether creditor-driven bankruptcies are taking longer than the ones that are driven by the debtors themselves. That is fairly intuitive, right? If the creditors are involved, like you said, credit committees take forever to take decisions on a number of things.
Right. But this is about whether a resolution process that is triggered by a debtor is likelier to close faster than a resolution process triggered by a creditor. So we find that resolution processes triggered by financial creditors are taking the longest to get resolved, or rather the probability of a resolution process triggered by a creditor is low in the short term. And so if a resolution process, on the other hand, is triggered by a debtor, then the probability of closure of such cases is higher within 180 and 270 days compared to the other litigants. So again, this makes me think that if we think strategically about it, then creditors are better incentivized to actually convince the debtor to trigger the insolvency, because if we just see these 761 cases, then if a debtor triggers the insolvency, the probability of closure is higher within the 180 and 270 day timeline.
Okay. Another of the findings, and Bhargavi, there's a whole bunch to talk about, but I'll focus on one more question, which was the difference of, within benches some Delhi, Bombay, where perhaps a large number of cases have been filed, are not showing such great sort of track records. But you have an interesting analysis of what that implies or does not imply.
Right. So, like I said, this is not just about the tribunal capacity. So you're right, maybe the more complicated ones are in Bombay and Delhi, and therefore the probability is lower within the shorter time horizon. If we had better granular data of how much time the litigation phase itself is taking, then maybe we could apply this methodology to just understand the time that is attributable to litigation.
All right, Bhargavi, leave it there. Quick findings in Bhargavi's analysis of them. Interesting piece of research there.
Out of time on the show. Thank you so much for joining us on Lunch today.